welcome to the Money Show. I'm Nayantara Rai. The Money Show is one of its kind all over India. The first one that brings markets, top financial experts to answer all of your financial queries. We have just one aim in mind: to help you get richer. So let's get straight down to it, and just a quick programming alert. You can also send us your queries live. You can email us or you can call us. Be old-fashioned. You have to WhatsApp, you have to email, or resort to Facebook or Twitter. And as you can see, our guest today is Feroze Azeez. The number is on your screens: 022-675-49498. You can also send us emails at themoneyshow@etnow.tv. Feroze Azeez on your screens, the Deputy CEO of Anand Rathi Private Wealth Management. Hi Feroze, always good chatting with you on the Money Show. Let's get straight down to it. I want to talk about mutual funds, which have started taking mark-to-market impact. What does it mean, when you look at the markdown of, for example, Reliance Home Finance? And one of the big concerns, and we get queries on this, a trend that started last year: negative returns on mutual funds. Is it still even a safe option?
See, Nayantara, when you're speaking of markdowns of several papers which have got downgraded or have gone default, then it's a very important and a serious topic. Point one, why? Because Indians have a lot of money in debt. Because the industry, mutual fund industry, has almost 60% or 70% of the money in debt, and about 9 lakh crores out of 25 lakh crores is in equity, which is little over 30% and less than 40%. So important debt funds are very important, point one. Point two, when you lend to a corporate, there are going to be accidents, there are going to be some defaults. So how do you react to it is very, very critical. Point one, especially from September 3rd, 2018, there have been a series of ups and downs with respect to certain corporates. IL&FS to start with, then DHFL, then you had Z and SL Group. Now we have Reliance, the ADAG Group, Reliance Home Finance, and Reliance Commercial Loan Division. So these are the 4-5 defaults or downgrades we have seen. So point one, what should an investor do? He or she should not panic. He or she should analyze rather than panic. When it comes to Reliance Home Finance, the mutual fund industry has an exposure of 2,300 crores in this specific issuer. The Reliance Home Finance has a total outlay to be paid in the next 1 year of close to 2,000 crores. So don't have to worry too much, because it's not a large quantum of money. It is there in only 4-5 funds, some Reliance funds and some SBI funds. So net the point I'm trying to make is, with respect to this specific issuer which you mentioned, Nayantara, there's nothing to worry. In my opinion, a recovery rate of 70 to 80% of the money is a very high chance. As per regulation, the mutual fund NAV has to be marked down to fair value, which is why there's a sharp drop in the NAV last week in schemes which actually had this. So nothing to worry, especially with this issuer, in my opinion. Reasons being, it's a 2,000 crore kind of an outflow for 1 year, which the company needs to pay up. It has a 300 crore EMI which is being paid to it. Third, Reliance Capital owns other businesses. Push comes to shove, those businesses could also be liquidated to fund this. And fourth, the NPA rates are less than 1%. So I think it's more of a liquidity crisis rather than a default situation. Of course, it's been downgraded. So that's the crux of it. I'm open to some more questions if you have any, Anand.
Feroze, but we get a lot of queries from our viewers who, are angry. For example, look at the SL case. They're angry that the AMCs, the asset management companies, have decided to side with the promoters, to give them time and not worry about their core business, which is to ring fence, protect investors and actually grow their wealth. Having said that, then how should one look at this, continue to look at this as an asset class? It's very easy to say don't panic, but when you don't even get all your money back and you don't get the rate of return, obviously there is angst and anger.
Yes, Narendra, I can of course empathize with investors because I am one as well. So what happens is, of course, anger and dissatisfaction when you don't get the expected return is going to be there. You have to be pragmatic on two counts. Point one is the alternative to investing in corporates is to invest in a government paper. So, and the government paper funds which are invest only in government securities or in very safe companies. I think government has negligible risk, especially central government, because it's sovereign credit, would anyways give you only a 6.5 to 7% post expense return. All these other funds which invest in corporates, even after these defaults, have given you 1% more for the last 3 years. Height of all the defaults, there is an extra return which you have made to an alternative which is zero risk from a credit standpoint. That certainly doesn't completely satisfy me as an investor, but it's important to note this, that as long as you're making more than the credit zero credit risk paper, which is the government paper, you're still left with a extra money in spite of taking this risk and the risk fructifying. Point two, sometimes it becomes smarter to not for the fund managers to not sell the stock which has been pledged to them, because that will be a last nail in the coffin and reduce the probability of recovering whatever you could if you sell the stock, because any sale of stock in the public market will ensure any strategic sale which the promoter can do to refund all the money which has been borrowed becomes negligible. In fact, globally, these are called junk bonds, or these are not even junk bonds, they're better than junk bonds. They are traded extensively in the US. Since our markets on the debt side are not as developed as the equity side, so people will start accepting this, that there will be 2, 3, 4% probability and defaults of issuers, and then these bonds are also traded depending on the expected recovery. So understandable, Nayantara, the anger is valid. Point one. Point two, you have to still be pragmatic. If large banks lend to corporates and have an NPA of 2-3%, it is impossible that the mutual fund industry is going to lend to the same corporates and have zero defaults. It's just that it has not had defaults, so people are not mentally prepared to take it. But after default, if you're making more than the government security paper, you're still better off having taken the risk rather than having not taken the risk in the first place.
Okay, so that's the views coming in from Feroze Azeez. When we talk about mutual funds, he's broken it down for all of our viewers right here on ET Now. But like we said, we're getting so many queries, so I'm going to now move on to that segment of the show. And folks, once again, a reminder, our phone lines are open. You can call us live to get free advice from Feroze Azeez and what you need to do with your portfolios and get richer. Otherwise, you may have to spend a lot of money to reach out to him. Having said that, let's get down to business. The first viewer query I'm getting is from email. Kumar Swami, who says, I'm investing 3.16 lakh a month across 16 funds like Axis, Franklin, smaller companies like Mirai Hybrid, Mirai India Equity, Kotak Emerging Equity, Parag Parikh Long Term, Motilal Multicap 35, HDFC Small Cap, Reliance Large Cap. I'm a long-term investor with wealth creation being the primary objective. Should I pare down my investment given the Sensex levels of 38 to 39,000, or should I continue these investments? Feroze, we've shared with you the portfolio that has been given to us by our viewer Kumar Swami. What do you think of it, and what's your advice to him?
See, I think for Mr. Swami, the first piece of advice is having 16 to 17 funds is not a good strategy. Of course, a per month investment of 3 lakhs is a reasonable amount, especially when systematic investment plan, the average size is anyways between 3,000 to 4,000. You are investing almost 100 times that, so amount is larger from a perspective of an SIP. But having said which, Kumar, you should make sure that you don't have more than 7 to 8 funds. Point one. Point two, when you're buying active managed funds, you're paying a fee which is inbuilt in the product. If you buy 16 products or 16 mutual funds, you will practically buy the entire market. So buying the market and beating the market is next to impossible. So you're wasting your fee because you're taking active management but over diversifying. Point three is the fact that since you are an SIP investor and the markets are at 38, 39k, I think you should still continue it, because for an SIP, any degree of market volatility, extreme volatility especially, is a good news and not a bad news. It's a good news because if the market went up, for example, after election results, you're happy that the money which is already invested is growing faster. If it corrects, you still have some good news, because the subsequent installments will come at a cheaper price or a better NAV. So SIP investors don't need to time, for sure. And lastly, the funds require some degree of change. Of course, you can continue with Mirai Asset India Equity Fund, Kotak Emerging Equity, HDFC Small Cap and Reliance Large Cap. The rest of the funds you've mentioned definitely require a relook. And definitely I think you can add some funds like Canara Robeco Emerging Equity and definitely Invesco India Growth Fund. These could be two additions to your portfolio, Kumar.
Okay, Mr. Kumaraswamy, I hope that helps you out. And if you have any follow-up queries, you can continue to stay in touch with us and email them to us or even call. Moving on to the next query. This is from Vikram Singh, our viewer, who writes, I have two dormant mutual funds that I invest as a SIP, Axis Blue Chip, Fund Growth, and I've shared those details with you. And he's also got Franklin India Equity Hybrid Growth. The present value of the two is 2,68,000. The interest earned shows 13 to 14% annually as of now. I would like to know, should I hold the money in the fund for further growth, or should I sell it to reduce my balance home loan of 23 lakhs with an 18 lakh principal that was taken for 6 more years at a 9% interest rate? So he has a home loan. You know about the two mutual funds he's invested in. Feroze, what's your advice for our viewer Vikram Singh?
So from his first question for Vikram, if I have to answer that, I think it's a very common question across several viewers, that should they continue their investments parallelly along with their home loan or any other loan. Especially home loans come at the least cost when it comes to a relative comparison with other loans. So you can continue a home loan, Vikram, because your rate of interest is 9%, and there are also some tax discounts which you get on principal and interest under Section 80C and other sections. So on loss on house property and Section 80C, you get some degree of tax rebate. So your effective cost of borrowing would not be 9%, it will be lower, which could range between 6.5 to 7.5%. So that's great news. Point two, you're earning 13 to 14% and you have earned it in the past. In my opinion, if you continue this for the next 4-5 years, it's unlikely that you don't make this again. So you will have a spread of 6% extra over and above what you're paying as interest. So point one, continue to the home loan, because you're making more money than what you're spending, and your tax discounts are bringing down your effective cost of borrowing from 9 down to 7. So continue it. Then coming to the two specific funds which you've invested in, Vikram, one is the Access Fund, the Franklin Fund. You can definitely continue with the Access Fund, but the Franklin Fund needs to be replaced with Mirai Asset India Equity Fund, which is now a large cap fund managed by Nilesh Surana, which is a very, very good fund manager. Bottom up stock picking capability is immense. So I think these would be a better bets from a future standpoint, not just a past performance perspective.
Okay, I do hope that helps out our viewer Vikram Singh, and if you have any follow-up queries, continue to stay in touch with us. I have to now, I believe there is a viewer of ours who's called in to the Money Show. It's Prakash. Hi Prakash, good evening, welcome to the Money Show. What's your query? How can we help you?
Yeah, I would like to invest 2 lakhs each in pharma fund, one mid cap fund and one small cap fund as a lump sum. But condition is they should have bottomed out.
Feroze, go ahead.
So I think Prakash, all the three categories which you mentioned, one was a sector fund, the other two were mid and small cap funds. Of course, it implies that you wish to take a higher risk to get the higher return. Of course, from a pharma standpoint, I think pharma is, as a sector, has bottomed out, to my opinion. Reliance Pharma could be definitely a good fund, because Sailesh Rajban, who's the fund manager, has beaten not just the broader other funds in the pharma space, but also the pharma index, which it tries and replicates. So there's an alpha generated over the pharma index. So Reliance Pharma fund could be one fund. If you look at funds which have actually not done too well, but are good funds, are HDFC small cap fund. Chirag Setalvad is the fund manager, very well diversified, agile fund which moves around and has a reasonable churn ratio to get you better ideas in the portfolio. From a mid cap standpoint, Canara Robeco Emerging Equities is a good mid cap fund which has had a bad performance over the last 1 year, not just from an internal standpoint, because the mid cap and small cap indices had rallied significantly in FY18, have corrected in FY19. But Prakash, please keep in mind that these have to be peripheral portfolio strategies. The core portion of the portfolio should still be large and multi-cap funds. If you have already quenched your thirst for those funds, is when you should actually go in the three funds which I just suggested.
Okay, Prakash, I hope that does help you out. Prakash was dialing in from Baroda with his question. I'm going to move on to the next video call. Shilpa Kulkarni calling into the Money Show from Mumbai. Hi Shilpa, good evening. Welcome to the Money Show. What's your question for Feroze?
Yeah. Hi Feroze. Firstly, I would like to tell you I'm a huge fan of yours, and I always watch shows like Money Show where you give very good advice to investors.
Oh, look at Feroze blush. Shilpa, what's your query?
Okay. I have around 5 lakhs to be invested right now, lump sum. I have I have shortlisted a couple of funds based on your advice, like Mira Asset India Equity and Kotak Standard Multicap. My horizon is about 7 to 8 years.
Correct. So
wanted to ask you basically how much should I put lump sum right now, and how much should be my STP value, and what should be the months of STP?
okay. Super Shilpa, I think thank you for the kind words, but importantly, when you're doing a lump sum investment, the funds which you've chosen are good. Mira Asset India Equity Fund is a good fund. Kotak Standard Multicap, Harsh Upadhyay, who is the fund manager, is doing a great job. But when you're investing lump sum, I personally think you should have some money in debt, because Indian interest rates are significantly higher, so bring stability to your portfolio. The first decision any investor for lump sum amounts, in spite of having 7 to 8 years, should take is the asset allocation decision. In my opinion, if there's 7-8 years, at least 75 to 80% can go into equity. So that's point one, advice one, 75 to 80 in equity, which is 4 lakhs out of your 5 lakhs, Shilpa. In the 4 lakhs, you should buy 4 funds, and then I'll tell you the mode and the period in which you can transmit it. So on the debt side, let me start with the debt side. On the 1 lakh rupee, you can go lump sum investment to the debt. One of my favorite funds, which gives you the little extra return, is the Franklin Dynamic Accrual Fund, and ICICI Regular Savings, which is now called the ICICI Credit Risk Fund. This 50,000 each is a good investment. On the equity side, you can go into 4 funds: Mira Asset, Kotak Standard Multicap, as you already mentioned, Reliance Large Cap, and HDFC Small Cap. So if you bought these 4 funds of 1 lakh rupee each, 50,000 right away, and the other 50,000 in the form of a systematic transfer plan in 10 separate installments of 5,000 rupees each, I think you would have sailed through the volatility which is expected to be thrown up by the election outcome, if at all there is adversity. So 50,000 rupees right away, that's 2 lakh rupee lump sum, the other 2 lakhs in a systematic transfer plan at a frequency of once a month, 10 such months, and then 1 lakh rupee in the debt side, Shilpa.
Right, Shilpa, I hope that helps you out, and that you can make more money since you follow Feroze's advice so closely. Feroze, is that your first brush with a fan on live television?
Some of the few, I must say, Nayantara.
Also modest. Okay, with that, we're going to take a short commercial break, but stay tuned. You're watching The Money Show. We'll be back in a few minutes. Welcome back. You're watching The Money Show. I'm Nayantara Rai, and we've got in our studios with us Feroze Azeez, the Deputy CEO of Anand, Rathi. A lot of his fans have been calling in, unfortunately, but towards the end of the show. Feroze, before I let you go, and as you can see, a lot of people are following you very closely for the advice that you give. What advice have you brought for our viewers today for today's edition of The Money Show?
I think the important advice is important that we check when it comes to NAVs, falls. Very importantly, you should make sure that falls are analyzed and you don't actually take decisions which are in haste. Point 2 is set your goals. Very importantly, before you embark on the journey of creating a strategy, having an objective is very important. The third small piece of advice I would definitely give you is managing money does not end at making return. Creating a clearly defined transition plan, making your wills, which I think is one very, very large missed link when it comes to personal finances. Creating a will, getting the nominations in place so that if there's an eventuality, it's not just that the family should not go through a financial burden, but just the emotional one which you can't avoid. So creating a will, registering it is an integral part of managing your money. Don't skip that bit, and I think if you can do these three, I think that will be small piece of advice to finish the show. Nayantara.
In fact, video wills are also being legalized. I know that's the case in New Delhi. So you can make a will on your video, so no one can ever say it's forged or it's not authentic, etc. Feroze, with that, I'd like to thank you. We're completely out of time on this edition of The Money Show. We look forward to keep getting you back on the show. And with that, viewers, many thanks for dialing in. Many thanks for sending us your queries. Keep doing that. We'll be back on Monday, same time.